My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll be able to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate. Context, call me 1-800-743-CNBC or tweet me at Jim Cramer. Maybe we're looking at it all wrong. Maybe we're so blinded by big tech, we don't realize that what we're seeing right now is a reasonable pullback after a relentless rally in some highly visible $100 billion and more stocks, virtual purloined letters of equities. And that's how I look at today's action. Dow dipping 252 points, S&P declining 0.76%, and the Nasdaq losing 0.96%. What do I mean when I say we're blinded by tech? Look, most people who own stocks tend to own the same stocks. So in many cases, they don't understand how incredible the rally's been this winter. For example, people care more about every nook and cranny of Netflix, fortunately, good signups tonight, so the stock goes higher, than they do about stocks like Boeing or JP Morgan or a host of other blue chips. Yep, so many great companies are outright ignored here, in large part because the mega-cap tech names are much higher profile and have gigantic mind share with the American public. We see them as the protagonists of the stock market. And to be fair, for a decade, that's exactly what they were. But that hasn't been the case for over a year now. Unfortunately, most people haven't adjusted to the new reality, something we implored people to do at today's Investing Club meeting. You gotta go watch the tape. The real truth of this market is that hundreds of non-tech stocks bottomed in mid-October or before then. Since then, they've been on a gigantic tear, just a huge run. And this week, they've finally taken a little breather. What happened at the bottom? Well, in late September, the dollar was peaking. Then interest rates finished their relentless climb less than 4 weeks later. In retrospect, these are the two very obvious events, but hardly anyone wants to believe in the bottom because we're so focused on the sputtering mega caps, the flailing semiconductors. And worst of all, the pathetic enterprise software giants. We've been stuck in a purgatory of our own making. Consider it a tech Titanic. All right, tech train wreck. So on one track, we had a very traditional bull market based on the dollar and interest rates peaking, both of which tend to be terrific for stocks for a whole host of reasons. But on the other track, we had the relentless beatdown in the Teslas and Salesforces and Amazons. It's absolutely insane that the second track gets, I don't know, how about 114% of attention? When I talk about the bull market track, it's not like these are obscure companies, people. Just look in your wallet, all right? I mean, look at it. Open it up right now. I command you. You'll probably see two things. You'll see a Visa or a MasterCard, two companies that are worth hundreds of billions of dollars. Visa is one of the largest companies on earth. Visa stock is highly sensitive to the dollar. It bottomed in mid-October at just under 175, then soared to 224. It's now at 220. I mean, look at this. I mean, you know, you have this rally, you have this pullback. You think everyone's crying about this one? Nah. Okay, I mean, you know, what MasterCard? Apple MasterCard. I love it because its symbol is MA. And MasterCard bottomed along with it's right along with Visa at 276. And then it jumped to $381. And even with the pullback, it's now in the high 360s. Look at this. This isn't much at all after this. Correct? In other words, these huge stocks have had monster happy moves in the last few months.
That was easy.
What we've seen this week is merely an orderly decline to burn off their vastly overbought conditions. I know you're thinking I'm cherry picking. Get this. It's not too hard. How about the nearly $400 billion JP Morgan? I mean, you probably heard of him. Remember Morgan? He was like really rich. A few weeks before bond yields peaked, this stock was at $101. It then blasted to $143. I mean, come on.
House of pleasure.
I often think of that when I think of Jamie Dimon. And let me tell you, JP Morgan, somehow it now pulled back to just under 135, despite reporting excellent quarter last Friday. And it was a great quarter. It was It was garden variety profit taking. And I know how to garden. It's Zen-like. Then there's Home Depot, a $316 billion company. The despot, which is what I like to call it, bottomed at $266 in late September, then moved up to $347. I mean, come on, I want that. So it doesn't. Home Depot Semiconductor. Ooh. And, you know, okay, so pull back to 310 as of today. Sure, we might have more rate hikes. And that's bad for anything connected to housing, including the despot. But we hear that every time there's a Fed meeting. And it hasn't stopped Home Depot. We have all these people, by the way. Well, no, let me say that for later. Travel's been pretty strong, right? There's only two companies on Earth that make commercial aircraft at scale. And that's, is that Intel and NVIDIA? No. It's Airbus and the poorly run Boeing. But once the dollar peaked in September, even though you buy planes in Boeing, in dollars, you buy Boeings in dollars, Boeing stocks started flying from 121 to 216. Do you see the pattern here? Do you see what I'm talking about? Okay, so now it's pulled back from 216 to 207. Woo, really scary. Hardly the sharp decline everyone keeps fretting about. I know it's only a $123 billion company, but it's hard to get more visible than Boeing. This one's been hiding in plain sight. Next up, we've been buying, you ever see any road work done, maybe a house road? Caterpillar. We've been buying for the Travel Trust. There are hundreds of billions of federal dollars headed toward infrastructure, and a huge chunk of that has to go to CAT. I can't claim we're early. The stock had been a real loser until the end of September, but then it pole vaulted from 160 to 260. Thanks to the recent sell-off, it's now down at 245. We convened our first investing club meeting of the year today, and we talked about how this decline, the first of any substance since that run began, might be the buyable moment. Buy. For the NASDAQ, it's still a bear market, okay? For Caterpillar, it's only a breather in a relentless bull market. Hey, go listen to the call that I did today at noon. You'll hear my partner, Jeff Marks, spell out the whole bull case. Now, we all knew that China had a ridiculous COVID policy, right? Sooner or later, it would have to end because keeping huge chunks of the country quarantined forever is unsustainable for 1.4 billion people. Wynn Resorts has a huge exposure to both interest rates and to China. Got a bunch of casinos in Macau. Stock looked deathly ill at $53, okay? Where it bottomed this fall, right? You got that there? And now it's at $99. Oh, just $1 below its highs. There's a pullback for you as the Chinese government finally came to its senses. Merck. All right, well, hey, you heard of Merck ever? Merck's another enormous company that's been hiding in plain sight. It's massively levered to the dollar because it does tons of business overseas, so the stock naturally bottomed when the dollar peaked. Since then, it's jumped from 84 to 115, no small change, and now it's plunged all the way back to 110, a whole $5 after a 31-point run. Oh, the humanity. Look, I could have gone on and on. I got like, you know, they tell me I can't keep doing it. Like at one point I have to stop. And I got these people who tell me, you know, like, look, you can't do it anymore. And I got other people over here saying you stop. You can't keep mentioning stocks. But I have like dozens of them. I have hundreds of them. I could have gone on and on with the same darn pattern. But you put that pattern back. I love that pattern. These are all like 100 billion. I just go like this and people do what I want because it's Jim Cramer's bad money. But the obsession with the... Wow, is my head big? Can I get out? But the obsession with the mega cap names has obscured one of the most straightforward bull markets I can recall. While people jumped down the rabbit hole of Intel or stumbled on AMD, the plain vanilla buyers of everything from healthcare to retail to aerospace and finance all got exactly what you'd expect. These stocks bottom when the dollar and interest rates peaked. Textbook investing obscured by wild emotions and really some self-flagellation. Now they're simply cooling off after a big run. Suddenly everyone acts like the whole edifice is collapsing. So many people come on our network or other media outlets and tell you things are dreadful. They're roving bears in sheep's clothing or little Red Riding Bears. They all spout the gospel of the Federal Reserve hand-wringing. When will the Fed be done bringing the pain?
The House of Pain.
We look for tea leaves from Fed officials who give Rotarian speeches, Babbitt style. Go Google it. That caused wholesale havoc in the futures. But if that's all you're focused on, you miss some huge moves. These keeps reverting to that. No, don't say revert back. You don't need to say the word back. There we go. Thank you. These rallies occurred while the peace with China broke down. The war between Russia and Ukraine got real hot. They continued after the election. They didn't even skip a beat when the semiconductors became roadkill and the enterprise software stocks rolled down so far that the analyst price targets meant nothing. So let's remember, there are two tracks out there. The tech track that can't seem to find its footing, rooted in about 30% of the market, and the other track, which found its footing months and months and months ago when interest rates and the dollar stopped climbing. Bottom line, both tracks are pulling back here. Tech after a 7-day pause from its bearish trend, the other from natural garden variety profit taking. I think the big blue chips are experiencing a temporary garden variety decline as the stocks digest their gains. Tech, aside from the ones that announced massive job cuts, they're on a permanent vacation to Jellystone National Park. All right, let's go. Oh, hey, speaking of Jellystone National Park, I think that might be in Wyoming. So why don't we go to Ken in Wyoming?
Hi, Jim.
Ken, what's up?
I gotta tell you, this is a thrill and an honor to speak with you directly, and that's not hyperbole.
Same. And you know who else is from Wyoming besides you? I mean, went to college there?
I think I know who you're going to say. A lot of us Wyomingites are rooting for Josh Allen.
Exactly. Let's go to work.
Okay, so I'm getting hammered by a bank stock, which seems okay to me, but I've been catching fallen knives since May of last year. I'm pretty bloody at this point. So what am I not seeing about Signature Bank, SBNY, that apparently everybody else is seeing?
People feel it has a little too much exposure to the quick rate increase. Remember, there's some banks that just had too much exposure. Some buy now, don't pay later companies that got hurt too. So yours is hurt by the fact that it was not positioned correctly, I believe, for the rapid rate increase. Now I want to go to Peter in Charlotte Panther territory. Peter!
Jim, how's it going? Booyah!
This is someday, I'll tell you. This is Thursday. What's up?
Not much, Jim. All right, here's my question for you. Coinbase, do you think the bottom's in, and what's it going to take for the institutional investors to get back into it?
I think that, okay, so Coinbase is a heavily shorted stock, and that means that even though I don't feel it's any place to be, it could have these rallies, but it is not in an area that I believe in at all. And by the way, I think that all the different, every one of these different, whether it be Bitcoin, whether it be Ethereum, whether it be Solana, anything crypto, I think. Sell. Help me here! I can't stop! I think the big blue chips are seeing a temporary garden variety decline as the stocks digest their gains. That's not the case with tech. That could be on a permanent intellectual vacation. On Mad Money tonight, the video game cohort has been volatile since COVID-19 hit our shores. But what could the future hold for the sector? I'm running through the big names and give you my take. Then earlier, we held our monthly meeting for CNBC Investing Club members. And we received so many incredible questions from our members that we decided to take some tonight. And today, CBC disruptor Ro launched a new weight loss program. I'm learning more about how this initiative and others are disrupting the healthcare space with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.